Now we are looking at, we spoke about large cap and mid cap and small cap. So we have other categories like mid and large and mid cap, then flexi cap and multi-cap. So all these things, could you just take us through?
Sure.
What is this three?
Sure. Let me talk about these three categories. The large and mid category is the one where you need to have at least 35% into large caps, at least 35% into mid caps, and the remaining can be anywhere. The multi-cap category is where you need to have at least 25% into each of the categories, large, mid and small. So at least 25% in large cap, at least 25% in mid caps, and at least 25% in small caps.
Multi-cap.
Flexi cap perhaps is the only category where there are no restrictions. That's one category which SEBI has given where it has not defined any rules, and therefore it has allowed the fund manager of such schemes to construct a portfolio without any restriction. So you could be 60% into large caps, you could be 60% into mid caps, you can even be 60% into small caps, there are no restrictions. So as the name suggests, flexible, you can be into any of the categories. Any of the market capitalization buckets.
Okay. Yeah. Okay. So when it comes to market cap, just to the value of the company, if you are going to buy the company for a full price, what is that price? And on that top 100, that is a large cap.
Yes.
That is what we are trying to tell. And when we talk about all the schemes, we spoke about three categories, large and mid and small, and we are talking about same thing, but we are mixing it in a different way. So when I have a portfolio of, let's say, large and mid and small separately, should I need to add this flexi cap and multi-cap and these category again into the portfolio?
That's a very interesting question, Nikhil. The advantage of these schemes is that one single scheme can give you a mixture of large, mid and small everything. So a multi-cap fund, like I said, has to compulsorily have 25% into each of the market cap buckets. A large and mid fund will at least have 35 and 35 into large and mid. So the advantage of these schemes is that by investing into any one scheme, you have a reasonable exposure across market cap buckets, which is not possible in the market cap oriented schemes where, for instance, large cap, we said 80% has to go only into large caps. Yeah.
Okay, that's interesting. So at least you should have this kind of allocation along with other allocation. But I think primary allocation, you can keep it for these three buckets, right?
Right.
Large, mid and small. Right. That is one thing. And so far I'm listening to you, what I can really get is that asset allocation is the key for anyone to invest, right? That's your real take. Okay, so that's good. And when we speak about how to invest in mutual fund, this is a kind of question for everyone. I think even if you are educating for now also, another 10 years also, you have to come and answer this. What is good? Is it a one-time investment or SIP mode?
I would say, Nikhil, SIP.
Okay.
All the way.
Okay.
And there are many advantages of this. The first advantage is, look, we never know what the direction of the market would be over the next 1 year. No matter how experienced you are, you can never forecast how the markets would behave. Suppose you make an investment of 1 crore rupees today, and suppose the market goes down by 5 or 10% over the next 6 months. You will have a huge amount of regret, to the extent that you may even shy away from investing your future sums of money into the markets or into mutual funds. But if you follow an SIP, if you break this sum of 1 crores into 10 installments of 10 lakhs, then you are at least able to invest some bit of your corpus when the market has fallen. Equally, if the market rises 10% and you're following an SIP, at least some part of your money enjoys the upswing while you're investing. So I would say SIP is important for this one simple reason: nobody can predict the market. You don't know what the direction of the market would be. It's always better to invest at different points of time in the market, so that you get the benefit of an average cost. So that's the biggest benefit of SIP. The second benefit of SIP is for people who want to have this habit of saving. We always say that your income minus your expenditure should be your savings, and therefore your investments. Warren Buffett, who's one of the most successful investors around the world, says your income minus your investments should be your expenditure. So please define what amount you need to keep aside for investment every month. It could be 10,000 rupees for someone, it could be 1 lakh rupees for someone, it could be 50,000 for someone. Please decide along with your advisor or your distributor how much money do you need to save every month and every year so that you can reach your financial goal. And that can be done effectively by way of SIPs. SIP helps you have that discipline of saving X rupees every month.
Okay, I think this is one thing which SIP kind of brought the culture for people who really want to invest, and unknowingly or knowingly they have fallen into this discipline and some money is keeping aside.
Absolutely.
I think that's a good thing.